Income in respect of a decedent, or IRD, is taxable income the person earned but didn't receive before death. Key exam trap. IRD is not reported on the decedent's final Form 1040. Instead, it's reported by whoever actually receives it after death, either the estate on Form 1041 or a named beneficiary on their own return. On the EA exam, they love asking who reports it. If there's a designated beneficiary, like a spouse or child, that beneficiary reports the IRD. If there's no designated beneficiary, the estate reports it on Form 1041. Think of IRD like a baton. It doesn't disappear at death, it just gets carried to the return of whoever collects the money. Common IRD items are basically money owed at death, unpaid wages or bonuses, accrued interest, dividends, and rent, retirement plan distributions initiated but not received, and for a self-employed person, accounts receivable, client invoices earned before death but collected later. These items can feel like they should get a basis step up, but IRD generally does not get stepped up. IRD keeps its character. If it would have been ordinary income to the decedent, it's ordinary income to the recipient. If it would have been long-term capital gain, it stays long-term capital gain. A classic example. The decedent sells property, dies before collecting the check, and the heir receives the proceeds. No step up, and the heir reports the same type of gain the decedent would have reported. 2 weird but testable payroll notes. First, wages paid as IRD after the year of death generally aren't subject to federal income tax withholding. Second, for self-employment tax only, a decedent's partnership SE income includes their distributive share through the end of the month of death. Also, accounts receivable from a self-employed decedent is IRD, but it's not subject to SE tax to the recipient. Now layer in NIIT, the 3.8% net investment income tax. Estates and certain trusts can owe NIIT, reported on Form 8960. The tax applies to the lesser of undistributed net investment income, or the excess of AGI over the threshold where the top bracket begins. Translation: estates hit NIIT fast if they keep investment income inside the estate instead of distributing it. Finally, DNI, distributable net income. Estates and trusts are hybrid pass-through entities. Income is taxed either to the entity or to the beneficiaries, but not both. DNI is the cap that limits how much taxable income can be pushed out to beneficiaries. The estate gets an income distribution deduction, or IDD, for amounts paid, credited, or required to be distributed, shifting the tax burden to the beneficiaries. Marisol has a traditional IRA, and she's also covered by a 401k at work. Because of that, she's made several non-deductible contributions to her IRA over the years. How does Marisol calculate the basis in her traditional IRA? The options include no basis at all, adding contributions and distributions, adding all contributions, or taking non-deductible contributions minus distributions. Think about it. The correct answer is the basis equals non-deductible contributions minus any distributions of non-deductible contributions. In other words, basis is what's left that hasn't already been recovered tax-free. This is tracked on Form 8606. The tempting wrong answer is adding distributions, because distributions reduce basis as you recover it. They don't increase it. Ethan turned 72 on July 30th, 2023. He's still employed full-time, and he has a Roth IRA. When must he start taking required minimum distributions from his Roth IRA account? The choices include never, the end of 2023, or an April 1st or April 18th, 2024 date. Think about it. The correct answer is never. Roth IRAs are not subject to required minimum distributions during the owner's lifetime. People mix this up with traditional IRAs and many employer plans, which do have RMD rules. But for a Roth IRA owned by the person, there's no start date while they're alive.